morning, ladies and gentlemen. A very warm welcome to all of you on Business Today Television, especially in our top end series, Market Masters, where you get to meet the finest brains on Dalal Street, professionals who are managing lakhs and lakhs of crore rupees on behalf of retail investors and have over the last 3 decades or so gone past all sorts of different kinds of market sentiment, whether it's bullish, bearish, volatile, or the pain that we are seeing at this point of time. It is my pleasure and honor to welcome Mr. A. Balasubramanian, MD and Chief Executive Officer at Aditya Birla Sun Life Asset Management Company. Bala sir is a very well-known market veteran. He started his life as a bond trader and is now the top man at Birla Sun Life AMC. He's devoted more than 20 years to this AMC and has weathered all kinds of storms in the market. He'll be discussing the state of play in the market at this point of time. Namaste Bala sir. As I have said, it's an equal pleasure and honor to welcome you. I wanted to ask on behalf of viewers, how are you reading sentiment at this point of time on Dalal Street? Top end GDP, rate cuts by RBI, very strong macro tailwinds, yet there is pain in mid caps and small caps. How do you explain this?
Yeah. Thanks, Banerjee. I think it's a pleasure to be part of your show as always. See, with the broader trend point of view, I think the way I see is the GDP has been quite strong. I think post GST cut, which came in the month of September, and October, November sales. If we go by the high frequency data now that comes in from automobiles and unrelated sectors, the automobile sectors. Also, if we look at the current marriage season, also it's reflecting on the hotel industries, hospitality industries, is also showing some kind of uptick. I think if you go by these lead indicators, definitely I think the broader GDP is actually doing getting better. Even the recent RBI policy also reconfirmed that GDP is doing well, real GDP is doing pretty well on the back of what I just mentioned about. At the same time, the inflation adjusted for gold, it actually almost close to about almost we can say zero types, which essentially means we have made a significant progress with respect to the keep the cost of goods and service under control, which is also leading to the rate cut is being considered by Reserve Bank of India in the last monetary policy. As a result of continuous cut in RBI rates, we also seen credit growth is also now picking up. I think broader basis, I would say sentiment is getting better compared to what we have seen about last few quarters back and what we are seeing today. There is a revival. Broader market is of course reflecting that in terms of Sensex touching all-time high, and the breadth and the width in the market is also rising. But we also see companies are able to raise funds by way of IPO. So that's also a trend that we are seeing, which is nothing but appetite for equity continues to remain strong.
Okay. Bala sir, let me just rephrase this question. What investors are unable to understand is that 29,000 crore rupees is coming every quarter into funds managed by AMCs such as yours. Mostly yes, these are devoted to small caps and mid caps, to some extent Flexi-cap and large cap funds too, but predominantly the thrust is towards mids and smalls. But here is the level of price destruction that is seen on a weekly level, on a monthly basis, is phenomenal. I am just asking, who are the people who are selling and which funds are forced to absorb, because obviously retail investors are not paying you money to be in cash. I just wanted to understand on behalf of viewers, why is this happening?
Sure. See, one thing that it's a good problem to have, I would say. At the same time, generally is not considered as a good from market momentum point of view, which is nothing but a supply. I think if you look at the number of issuance that's coming in the market, both in the primary as well as promoters want to take some divestment out of the offer for sale kind of things. Those are now coming, and I think hitting the market at a continuous interval. That's why if you look at supply never stops. I was just talking to one of the merchant banker a few days back. They themselves are too busy in actually by helping companies to raise capital from the capital market. The number of the hours time spent in these issuances, making sure they're successful, if something takes a lot of time. So this actually comes at the cost of two things. One, of course, whatever mutual funds are paying is only so much of money is available. FIs have not been the large participants; they have been absent. And other institutions like NPS and insurance companies have been active participant, and also the HNIs who have been coming to the market for participating. But because the supply is increasing and the demand only can be so much, it always comes at the cost of either to sell something to buy something. That's I think circle in which I think we are there currently. I would suggest, I would rather assume because of the active participation coming through the mutual fund, which you might refer to the 20,000 crores of SWP flows, which is nothing but domestic financial savings coming into the equity capital market as long-term investing, is basically the good sign, though one may absorb using this money available for the increased supply of issuance in the market. But as the earnings starts coming in, which is what I think the expectation, what I mentioned earlier, the GDP is a function of reflection of the economy. The interest rates coming down is also a reflection of RBI comfort for rising the credit growth in the industry. Therefore, the next 3-4 quarters, as the earnings starts improving, you will also see corresponding rise on the stock price as well will come. Therefore, we should currently at this point of time see the current market conditions is moving in the band largely on the basis of the supply demand. I would probably say it's more in supply than the demand. So that's the current scene which I'm seeing from the broader market point of view. The number of issuance coming in is far higher than what the market could absorb. Therefore, it always comes at the cost of somebody selling and somebody buying types.
Okay. Bala sir, your grounding has been into bond markets, which are far superior, and they read, signs of pain and signs of pleasure quickly than equity markets. What are you absorbing from rising 10-year Japanese bond yields? Do you think that is the root cause of pain that we see everywhere globally in risk on assets? Look at how silver and gold are rising. Look at how the Japanese 10-year bond yield is highest in the last since 2007-2008. What is it telling you?
One of the areas which of course I think is going unnoticed as one of the potential risks is the rising fiscal deficit. I think it's not just, I think you mentioned about Japan. I think it's, if you also refer US, the whole tariff discussion that Mr. Trump has been talking for quite some time. It is not that tariffs are high, it is the pain point that they have in terms of large fiscal deficit they're running is quite high. At the same time, the growth is quite mixed. I think if you are, if the inflation, Japan was actually looking for inflation before, and now the inflation has come back, therefore the rising interest rates. They have lived through the 20 years of negative interest rate regime for 20-25 years of negative interest rate. Now I think it's coming to adjustment factor. And third factor which I think is impacting the global market is the currency related adjustment that we are saying. Because of the tariff thing, the trade balance between which countries completely undergone a change. Even for India, if you look at it, trade balance with US, it's a positive, but given the fact that exports are coming down, we are also seeing some bit of dip in the exports. And with China becoming an alternate for source of materials,
okay,
the trade balance with China is getting negative. So these are dynamics are changing. The way I see the bond market, it's currently behaving as they are behaving, largely driven by fiscal, largely driven by the rate cut may not happen as quickly as possible as we have seen in India, whereas global market is not going to be as fast as what you are saying. So that's why I think we are seeing both the Japan and the US bond yields are rising. That's actually one of the reasons why even Indian bonds, despite India is actually in a sweet spot both on the fiscal, on inflation, as well as on internal rate of growth, I think far higher than what you are seeing in the global market. But still we are also moving a band is mainly keeping in mind the dynamics that is emerging both on the international currency market as well as the bond market globally.
Okay. Bala sir, before we shift to financial planning, I'd just like to ask one more question. The rupee has begun its life beyond 90, one of the worst performing currencies in Asia, and that's also keeping our foreign funds away from the market. How do you see the rupee at this level? As a former bond trader, do you see comfort at say 90.5, 90.6? What is the right value of the rupee according to you?
I think what has happened to rupee in a sense, it is in line with what are the expectations, given the fact that Indian rupee had outperformed the global market for a very long period of time, and this is the first year they've let go the rupee dollar to go to about 90. It is in some sense, it is also beneficial from the exporters' point of view. It helps, especially at a time where there is an FI's outflow, and also we are seeing FDI inflows have been reduced, where the exporters can make more money. In that sense, the rupee going about 90 is not an issue. Plus, global energy prices remains somewhat under control. Therefore, we are also not importing inflation from global market because it's led by the currency. So my assumption is, I think once the tariff settlement happens, which is what I think all of us are having high hope that soon we'll reach some kind of settlement, assuming it happens before the year end, then we will actually get some kind of reasonably good handle on the currency in terms of rupee dollar moving a little more better than what we have seen. But I think it's $90, it's something. I think it's going to stay for some more time, given the fact that we need, while the domestic economy should grow, we also need exports incentive. If we cannot give them by way of tariff, at least they get by way of currency being in favor of them.
Okay, fair point. Let's now focus on the most crucial part of investing, Bala sir, which is planning for retirement, planning for a quality of life which we are used to while working. You and I have discussed this much often. How do you suggest at this point of time, given the inflation, given how artificial intelligence is slowly but surely eating into entry-level jobs, how do you suggest people who have entered the job market at this point of time plan their financials for 20, 25, 30 years?
Yeah. Well, clearly, those who are getting into the market, I think they are getting at the right time for one simple reason. The aspiration for India to grow at an average rate of about 7.5 to 8% at GDP level, with a normal GDP of close to about 11 to 12%. And also we are marching towards a $10 trillion economy. Therefore, somebody who is beginning their career, they must look at SAP for life. I got SAP for life, which is nothing but you put every month out of your savings continuously every month. So if I'm starting at the age of say 30, I need to assume that I'll work at least minimum of 20 years, if not full 30 years, up to the age of 60. That means they can not only plan for creating a wealth by way of SAP, they can also actually plan for the retirement by way of SWP. So this is for the people who are say the age of 30. Even the people who are the age of 40 or 45 never plan for their various expenditure that they may incur on a month-on-month basis, as well as the income level comes down, expenses are not going to come down. Therefore, we will also create some bit of room for them to build on size and assets and wealth, which I think ultimately will come in handy to meet the potential expenses that may come as and when either you give up your job or retire or many other purposes. So that's something I always encourage people that doing SAP is a must. And as long as you're able to continue the SAP, as long as the monthly income remains 100% of your, as far as possible, not 100%, as far as possible, maximum amount of money which you can save, I would say save by your SAP, At the same time, at the beginning itself, you get to a discipline of withdrawal plus WP. Therefore, you will be bound for the entire period of SAP. So, assuming you take it for say 10 years minimum, after that you will withdraw. At least ensure that that you save for a minimum of 20 years, 10 years, or 15 years, and explain that as you mentioned, minimum of 30 years. Then this process, you actually make your growth, make your money grow and create wealth for you silently, very quietly, by way of the disciplined approach of investing for SIP for life. So that's why I always suggest a lot of people. In fact, I myself have been advocate of investing SIP. The way even personally I do is actually is as far as possible beyond the estimated expenditure we may have on a month-on-month basis. Ensure that all the money is invested in SIP so that you are able to create wealth in order to have better future by way of your withdrawal plan. So that's what I think one should continue to do in a disciplined manner in order to protect themselves from the rising costs, which I think would remain real, which all of us have seen today. There is a significant rising cost right from maintaining your house to buying a house and maintaining a house and planning for educations both in India and abroad. So all these costs are rising. Even the travel cost is also keeps rising. Therefore, it's a better way to plan your rising costs through the SIP and subsequent to that through this WP, which you call it as SIP for life.
Okay. Bala sir, at this point of time, when you see the pain that is happening in mid caps and small caps, one, do you suggest retail investors continue their SIPs in these funds? Because ultimately it's the fund manager responsibility to keep on spinning the portfolio in a manner which reflects future growth. Two, what is the allocation at this point of time between flexi-cap, large cap, mid cap, small cap funds that you would suggest to a fresh investor wanting to put in 10 lakh rupees a month, 10 lakh rupees as a starting corpus in Indian equity funds?
The way I look at the overall asset allocation, 55 to 60% or even 70% of the asset allocation should go towards flexi-cap, which invests in across market cap. Second is multi-asset allocation fund, which again invests in across asset classes like equity, fixed income, gold and silver. Multi-asset allocation fund should be the second. And third is also keeping in mind the market volatility, which I call it the balance advantage fund. Sometimes people do have a question mark and make mistakes of withdrawal when they see the market become very extremely volatile. Therefore, balance advantage fund, which generally I say you can keep it as a permanent asset class, 65 to 70% allocation should go towards that. In fact, the maximum SIP should be done into the flexi-cap fund, multi-asset allocation fund and balance advantage fund from a longer term point of view. The small and mid-cap is something which gives you an alpha over a period of time. It comes along with the associated risk, which comes through the intermittent volatility. At the same time, these funds, we have to look at it for 7-8 years kind of time period. If somebody is doing SIP in mid and small cap, I think they should continue as long as they have to remember. As long as they remember that I'm investing for not for 1 year or 2 years, I'm investing for 10 years and beyond. I think that discipline, if we keep across all asset classes, my own belief is this allocation goes towards flexi-cap, multi-asset allocation fund and balance advantage fund, followed by some allocation towards small and mid cap. I think will largely serve the purpose. And the large cap fund you also asked about, and large cap fund can also be met through the flexi-cap fund. Therefore, not necessarily you have to choose large cap fund on overall asset allocation basis, as long as you have significant portion of your money invested in the flexi-cap fund.
Right. On that wonderful note, Bala sir, we'll call it a day. Thank you so much for the reinforcement of the SIP plus SWP initiative that is the key bedrock to financial growth and happy retirement, and also on your views on the bond market, broader GDP and of course the rate cuts that have happened. Thank you for your time, sir.
Thank you, thank you, thank you.
Okay, that, ladies and gentlemen, was Mr. A. Balasubramanian, MD and CEO at Aditya Birla Sun Life Asset Management Company. Be glued to Business Today Television. There's lots that's happening on the other side of the break. Thank you for watching.
Perhaps if the Ministry of Civil Aviation through DGCA, in partnership with another regulator which comes under the Ministry of Corporate Affairs, the Competition Commission of India,